Welcome to our side event here, organized by the European Roundtable on Climate Change and Sustainable Transition. It's on a carbon bank to manage the transition towards the low carbon economy for EU and globally. And it's something that we would like to expose the audience here in Dubai for the simple reason that it is a very pertinent conversation. If nothing else, removals is very much on the table and very much one of the issues for discussion. So we feel that it's important that this discussion takes place. We're very disappointed that there are not more people, but we're very happy that you're here. So thank you very much. I did shoo out some people, but they were not listening. Now, I will introduce the panel, and the panel is a European panel because this is where the discussion is taking place right now. So from my left to my right is Ioana Petcu from Euroelectric. Ioana, it's good to have you. Thank you very much for being here. Daniele Agostini from Enel, electric power utility of Italy, global power utility, but also somebody who's been on global carbon markets discussion for a long time, also on the board of AIRA. Robert Jeske from Kobice, which is the agency, the emission trading agency in Poland. Robert is in charge of all the research and all the advisory work that they do in Kobice. And last but not least, Philippe Chevaux from Solvay, who has also been around for a long time in terms of dealing with carbon markets, having responsibility for regulatory affairs, but also have responsibility for compliance in Solvay. And Solvay has had a very big presence in the carbon markets over the years. So having said this, I think that since we don't have a huge amount of time, what I wanted to do is to go very quickly and explain to you the genesis of this discussion. The genesis of this discussion is relatively simple. Is a number of years ago, there was an issue around managing carbon markets in Europe. And there was a surplus. The surplus had a variety of reasons, and people are trying to figure out how to deal with it. A number of proposals came on. One of them came from Enel, which was the market stability reserve, which is a very quantitative type of approach to managing the liquidity in the emission trading system, because there was a surplus of liquidity as a result of the financial crisis and as a result of an oversupply of CDM credits. But there were other proposals. Another proposal came from Paris, from the University Dauphine, from Christian de Pertuis at that time, which spoke very much about a carbon bank. And the reason for that discussion of why he brought in the carbon bank as a concept was because many of us, and some of us, not necessarily all of us, but many of us regard allowances that are being traded in emission trading system as akin to a currency. And currencies are being managed by central banks. There was, anyway, that discussion at that point really didn't go anywhere with respect to the carbon bank. It really went on the level of the MSR, which was quite successful in doing a number of things. But the question will be, was this fit for purpose in the future while it was doing the job in the past? And I will try not to get you into a lot of the salad of European policy and politics as to why some people think this is the right thing and some people think it's the wrong thing. I'm not sure which slide we're on, but we're not. Yes, but this is not moving anywhere. Point it to where? Where do I point it?
Don't point it to me.
It doesn't shoot. Sachi, maybe you can change it. It did change? Okay. So at least I have it on I was careful enough to have it on my iPad. Hi, Peter, good to see you. So what is at stake? What really is happening from the European point of view, and again, we started with the genesis of an emission trading system and the European emission trading system, is that by 2039 you start running out of allowances. it literally, mathematically, you run out of allowances. So it's going to be a situation where by 2030s, people are going to kind of realize that that is the case, and the liquidity will disappear out the market. So you're going to have a very high price one day, and then presumably at some point the price is going to drop to zero because there's nothing to trade. So what exactly is going to happen? The other part is the fact that we do not have right now removal certificates as part of EU ETS compliance. So the question was, are these going to be necessary? Because if we're talking about a net zero by 2050 or 2039, then at some point this will become a necessity, something that will be necessary to have. So the issue that we brought up at this time is this a moment where we have to reconsider the architecture of what we have. Is this a moment to reconsider the fact that the MSR may or may not continue to be an appropriate way to do business and to manage the emission trading system? The MSR, for those of you that don't know it, is a mechanism that basically takes liquidity, takes allowances of the market in times of surplus, and supposed to inject allowances into the market when there's a shortage, certain variations in liquidity in the market. So far, it's kind of worked in one way. I mean, it's absorbing a lot of stuff. He hasn't been in the situation to put anything. But it's a very rule-based type of stuff. Is a mechanism that has lines, has red lines where you start taking things out and putting things back into the market. The question is, as we move, so if you want to go on to the next one, Sachi. Yeah. So the question is, why would you even consider this? You have a mechanism that is working. So, if it's not broken, why fix it? And if, don't change the winning team. That would be the logic of what we do. But the issue is really, can you continue to function with an automated machine when the markets are beginning to move very, very fast? And it is an appropriate machine where it seems to be working very well when you move in a certain direction, when you have surpluses. It's never been tested really in situation of fluctuation with the pluses and minuses. So is this something really that MSR, which has a delay of 2 years, and a certain amount of rigidity built into it by the rules, it is something that can watch. The second thing is we have the precedent of central banks. Central banks manage currencies through interest rates. This is very much allowances. A lot of people see it akin to a currency. So if that is the case, is it justifiable in a very, very sensitive currency that will manage the energy matrix of the country? Because that's what an ETS does. That's what an emission trading, a carbon does, will arbitrate and decide what the energy matrix of the country is. Do you want to have that on a fairly rigid system, or is it so sensitive? And what we see in the EU right now, it is a sensitive issue because the prices have shot up quite significantly, and the reaction of the government sometimes is unpredictable. Now, what other things will militate, such if you want to go to the next one, what else would we militate for that? It can be seen as a tool for market stability and liquidity, especially in a relatively scarce scenario. It could help that disruption moment where you're at the end of the period of the trading period ends up in about mid-30s, where you're going to have a very high price, maybe then a very low price. Can you manage that situation very much? It could also be seen as a mechanism of dealing with removal certificates. And why removal certificates are important is because if you need to get to net zero, you will have to have removal certificates for hard to abate sectors. You'll have cement, you have steel, you have aluminum, you'll have a number of hard to abate sectors that will require removal certificates. The question is multiple. One of them is, how do you get these removal certificates in the market? How do you get them started? So the idea would be, one of the function of such an institution, such an idea of a bank, is that you'd go into the market and actually start procuring this removal certificate at an early stage and then make them available when they become necessary. So it's an early provider of liquidity. The other idea that is quite clearly an important one is what actually the Article 6.4 is proposing, is the fact that you have reversal. And somebody is going to have to take the risk for reversals. Now, you can have a reserve, and you put allowances in that reserve in case there is reversal, or you can have somebody with a very deep pocket, with a very big balance sheet, take the risk and keep that for reversal. But somebody is going to have to guarantee that, because there's obviously a risk. And it's not a question that we don't want them or we don't need them or they will not happen. They will happen. So the question is, how do you manage the risk? How do you hedge the risk for this reversal? So this institution, these functions of whatever it is, whether it is part of an existing institution, whether it's a new institution, is not really that important. The important thing is, do you need to provide these functions at the EU level? Because you have liquidity problems, somebody is going to have to manage the liquidity. The second thing is, you will have to deal with removal certificates. There will need to be liquidity injected in the certificate market, but also somebody is going to have to provide the backstop and take the risk for the removal certificates. This is a EU discussion. Coming here, obviously in Article 6.4, that discussion is very pertinent. And the way they propose to do it, they create a reserve fund where they take a number of, every issuance will have a number of certificates put in there. Something happens, you start drawing things out. Possible, that's also another alternative, that's another way of doing it. But the question is who's going to manage this, and whether this is, whether an institution such as a big multilateral bank would not be better suited to deal with a situation like this. Again, this is a proposal that these are ideas that have come into the ideas in the market of ideas in the EU many years ago. As many of these things, they went away. But now that we're getting into the situation of having a situation of beginning to reach, especially in the mid-30s, starting to reach towards the end of the line and to net zero, especially in the emission trading system, there are people such as Professor Edenhofer, who is the chair of the Scientific Advisory Committee of the European Commission, Artur Rungemesge, Jos Delbecq, a number of colleagues and people that are in various positions or have been in senior positions within the European institutions who are bringing this idea, this discussion back. And he seems to be catching some fire, but within the context of removals, not in the context of a managing of liquidity. It is much more a removal tool as opposed to a liquidity tool. But once you start the discussion, then you examine all the possible uses that such an idea may have. Now, some of you will find it an anathema, some of them will find it a stupid idea, and some of you may find it an interesting idea. But what I can tell you is that it's something that is being taken seriously in the context of European discussion, and this is something that is being taken quite seriously here in the context of Article 6.4 in another format, but it's here. And it's something that will need to be considered if removals, which are a critical part of reaching the goals of the Paris Agreement, the net zero was based on removals and the training of removals from where the removals took place to where the emissions take place, will need to be dealt with. The reversal risk of that will have to be taken care of. So I'll leave it here now. We are a think tank. We specialize on being provocative. So now that we have been provocative, we let the other folks kind of weigh in and tell us whether this is a crazy idea. So Ioana, I'll start with you.
I have one here.
Oh, you have one there. Go ahead.
Is this working? Yes.
Yes.
Hello, everyone. My name is Ioana Petcu. I come from Euroelectric, which is the European Association of the Electricity Industry. Thank you very much, Andrei, for the invitation, and I'm happy to share some thoughts with you today. I thought about this topic more from a global context rather than purely European, considering the audience and considering the fact that we are at COP28 today. And I think we all need to consider a fair carbon price going forward, something that does not empty our coffers, and does not further fragment the market. But what we have seen so far is that business as usual is not working. We've seen a lot of reports from the IPCC, from global scientists that are telling us that climate change is actually accelerating, and we are not cutting emissions at the pace that we were supposed to do. So I think it's time to unlock net zero, and I think it's time to move beyond green wishing and go to green doing. This is something that's something really important for us, and in this global context, we should all consider it. Carbon pricing is one way of doing that. It's a tool that we have in our portfolios, and in Europe it has been working quite well. It has been considered for quite some time the cornerstone of our climate policies. In the power sector, it has delivered. We are on our way to net zero. We are hoping to have zero emissions around 2040. This means we need to scale clean sources of generation, and we need in parallel to remove fossil fuels. This is an action that needs to happen also at global level and not only in Europe. In Europe, the emissions trading system has removed 40% of the emissions since 2005. 2005. So to get the world on track to net zero emissions, I understand that the IMF is saying we need a carbon cost of around $85 per ton of CO2, up from $5 per ton today. This is at global level. This is hard to stomach for a lot of countries, a lot of constituencies, but also for heavy industries in Europe. $85 per ton is pretty much what we have now. It's a bit above that, and we have heard a lot of our industries and industrial consumers saying that is too much and too tight. And we do not want decarbonization to deindustrialization in Europe. So I think the Carbon Bank could have a role here in ensuring that we have manageable cost compliance, and we support the industries to transition. Momentum is growing for carbon markets. There are 73 carbon pricing mechanisms across the world in 50 countries. This is not all the world, but I think more will get there. So as this idea goes global, it will be important to know what we do with the revenues collected from these carbon pricing mechanisms, whether they are emissions trading systems or carbon taxes, depending on the system that constituencies are planning to get. And what could be the role of the central banks? I think one could be to address equity issues, because countries are different. Their abilities to support carbon pricing is different. So maybe something that has different carbon pricing floors for different areas of the world that are possibly, let's say, connected to their historical emissions also, and their trajectory to net zero could something that this bank could cover. It could reduce fragmentation through credible standards that we could all share at the global level. It could be a vehicle for developed economies to coordinate aid and technical support. It could be something that could enable lump sum cash transfers to customers, to consumers. But I think the biggest role that this carbon bank could play, it will be to ensure manageable compliance costs and to minimize the volatility in the market.
Thank you, Ioana. So I will go without much ado to Daniele, who is probably also from the same industry, if you want. I mean, he's a member of yours, so it would be interesting to see where he comes on that. Or else you're in trouble. Let's see.
No, thank you. So, very interesting topic. As you said, it goes way back, and we have a lot of lessons learned, because I guess the first time around, the World Bank did play an important role. I think we need to distinguish very clearly, and you mentioned in your intervention, Andre, there's a role for a carbon bank to sort of oversee and supervise what the markets are doing. You know, a bit like the central bank, so setting and intervening on the market. Now, as a market player, we see that intervention. There's a trend of increasing regulatory intervention by governments in electricity markets. We've seen in Europe, in carbon markets. So we don't see that type of trend as a very desirable one. You know, you just get tempted, and then it's very difficult to hold back. However, we see more a bank as a facilitator of market forces, of trying to help the imperfections of the market to smooth out. One of the big problems that we have in the carbon market, of course, is the lack of long-term price signals. Today, carbon markets, both in the compliance space and in the voluntary space, reflect signals that go maybe up to 5 years. A lot of the longer-term price forecasts are based on analyst views with models and industry expert. We believe a carbon bank, by buying more, you know, with a long-term view, you know, similar to something that's going on in the renewable energy sector with PPAs, can help the right carbon price, the true, not the right, because it's not a question of trying to steer the carbon price signal in a certain direction, being, you know, way out of bound in terms of political acceptability or not, but to make sure what it needs. I'll give you an example. Today we know that, you know, for CCS or hydrogen, we see carbon prices, you know, according to the numerical models, that go way up to 150 euros a ton or even above that. Now, 5 or 6 years, and again, Enel has been very active in renewables. They said, you know, that to do renewables, you needed a carbon price of 100 euro per ton. But we developed a lot of renewables without that kind of price. So again, there's a gap between the theoretical carbon price and the true carbon price. And I think a carbon bank, by procuring, by going out there and buying projects, can have a very important role. So I think that's especially true at the global level. At a regional level in Europe, again, I wouldn't see a carbon bank trying to do what the MSR is trying to do, but rather, again, trying to get the right level, the true carbon price to emerge with some of the technologies that we have in Europe in terms of hydrogen or renewables, which today are, you know, there's a big uncertainty beyond the sort of desktop calculations of what the real carbon price is. So again, a carbon bank that does not interfere with the market, but a carbon bank that facilitates and helps the market emerge and accelerate, because at the moment the market is developing too slowly. So we do need a player to come in with a long-term view, but again, to help the market, not to crowd out the investors, private sector investors.
Very well, Daniele, we can come back and argue one way or another on this. Robert, I know that you and Poland and Kubica have been concerned about especially volatility and whether this is something that would, you know, from the Polish point of view would be interesting or not.
Maybe I won't say a Polish point of view, but maybe from the point of view of markets as it is. So the volatility that we observed, where the shock and speculation occurred in just before the war in Ukraine, that makes us all shocked, and that was the thing that never happened before. So the prices just jumped, and the political tension to intervene on the market was enormous, and it is obvious that it's something would have to be done with the market to make it stabilized. So the ETS is at the beginning it wasn't market oriented. It was just CTS, like the market instrument, but it's market on paper, but not in reality. And as far as we go with the prices longer than 25 euros, then the market side of this whole ETS showed up that we have to be some kind of monitored and some kind of intervention are needed. So the MSR was introduced to the market before. So the reality of the MSR was to suck up the sole price of allowances, especially coming from the possibility to use the flexible mechanism certificates from CDM and JI projects, and that was done. So just to make you with numbers, we at the moment we invalidated like 2.5 billion allowances from the market. So this is like we are on the market which is tight, and it's gonna be tight even more up to 2030 and even up to 2040. So that means that this evolution of the price could be very difficult and dangerous. That means that MSR is not, I think, with the, of course, MSR is a complex matter itself, but just to make you overall view, this system is the MSR system within the ETS is working on the one direction, as was said, and given the fact that the market will be short in before 2040, that means that the price can behave very dangerously. So the MSR is not the solution for everything at the moment, because there is no problem that it was addressed to. So the carbon bank is a kind of multi-structural solutions that we observe as a solution for developing ETS suited for reaching net zero in 2050 and even more. So just to elaborate on that, this aspect that we raised, like the removals and behavior on stability of the price behavior of the ETS is interconnected. So these removals that you have to move the market of removals as such at the beginning, where the removal certificates and the cost of the removals are very high. So that means that you have to introduce the demand for these removals units. And at the same time, when the scarcity is low, then you can use the bank opportunity to introduce to the market removals. That makes us more, fluidity on the market and a robust market as such. What is also interesting, and with Article 6 you've mentioned, that if we manage to do in Europe more coherent, stable system that is envisaged to 2050, then it's a solution also for using this in other regions, because this cost, the reduction cost of the marginal abatement costs in sectors that are already in ETS are high. But we don't forget ETS2, where we have a transport sector and even more the agriculture sector, where the cost of reduction are over 1,000 euros. So that means that we are talking about the cost of 1,000 euros per ton in European Union. So imagine in other systems around the globe this kind of level of prices. It's impossible. So that means that we have to open much around not only in EU but also outside of the EU. And this is also a solution. So if you make it's right, and the bank will be ready before 2040. That means that we have a solution for existing with ATS, not only in Europe, but also globally. So I'll stop with that.
Yeah, so Philippe, what you heard is whether it is a kind of managing the market and replacing the MSR. We can argue yes or no, but we'll get to that. A long-term price signal is another one. Backstopping and covering the removal risk, somebody who will take the risk of removal because you will need removals. I don't know, I mean, you come from industry, you've been in the carbon markets, not only in the EU, but globally in Korea, because your company is active there. What's your reaction?
Thank you, Andre. Before talking of 2040, we have the early 2030s in the ETS. That will be my first point. In the way I see it, the ETS has been working on the back of the power market, which was super liquid and which helped create the liquidity within a couple of years of a time horizon. Now, Europe's trying to a very strongly renewable-based market, which changes the behavior of power players. They will not need to hedge as much long-term as they need it to be, and And basically, because they'll have less emissions, faster than the rest of Europe, they will have a lower volume. So from those two angles, will they be replaced by industry? Not that much. Although industry will have to buy more because of the CBAM and less free allowances, etc., but not with the same dynamics in terms of market intervention. So I see a question mark about real activity, whether the market, how the market can stay as much alive as it has been historically. And here I'm not talking 2040, I'm more speaking of the 2030s, early 2030s, or let's say 2030 to 2035. So that's one point. And the central bank, or a central bank, can be one tool to help respond to that. Now, the second point is that we, as an industry, we've taken an ambition, a goal to achieve carbon neutrality for our operations, in our case by 2040, and we've said openly that it will involve a share of offsets, so say negative emissions one way, okay? Which we will need to invest in Europe, elsewhere, as well as elsewhere, because we have our operations globally. And here comes a point, and I'm taking back the history of the CDM, etc., which is, if I'm buying an offset from somebody and it has, with negative emissions, a risk, I need a de-risking as a buyer. I will want to find some de-risking. And if I don't find it, there will not be a market. Huh? So either it's a company which has very deep pockets, which invest into these negative emissions and sell them to me, and I'm taking the risk, the counterparty risk with that. Or it's somebody which has less deep pockets, and here the creation of a central bank to de-risk from an investment standpoint makes a lot of sense. That's what we saw originally, and that's what the multilateral banks did in the years of the CDM, so that's a very good lesson to build upon. But we need that. So from those two angles, the point of creating the right instrument, both to keep liquidity in the market and to create de-risking, I think that's a very relevant point that you're raising, Andre.
I was saying I'm worried because I actually agree with you. So this is starting to. It's going to be less fun than I thought.
Very well.
I can only disagree with Andre now.
and they know each other very well. But anyway, I mean, there are a number of people. I mean, Dirk, remember this thing? What was it called? We were kind of an exchange place where people will bring different currencies, almost like a central bank or something with many windows that people will get with EUA and the different type of allowance and then exchange them. But somebody would have the power to actually be the exchange place. There was something that, who was it? It was a bunch of banks that were trying to do this in 2004, 2005. I can't remember. But anyway, it didn't go anywhere. It was a great story. We had a couple of good lunches over that, but didn't go anywhere. But there are all kinds of ideas. That the question is, how important is really the carbon market going to be? I mean, it plays a role in the EU. It doesn't seem to. Our old dream of having this global market with risk and exchange rates and what have you is really not coming to happen. If that happens, then all these kind of instruments may become more necessary. But for the moment, what Philippe has mentioned, that of the risking, especially if you deal with negative emissions, nobody will take the risk because nobody's got deep enough pockets, staying enough pockets. Somebody is going to have to be in that business. It's something to think about. So I'm opening it now to, unless somebody wants to react first to what they heard from others. Daniele, you agree with Philippe, but other than that?
I agree, and I'd like to reinforce. I mean, I think the de-risking is very important, and again, environmental integrity is an issue. Obviously, you know, I truly believe that the private sector can deliver that integrity. However, it's not what I believe, is what most of the stakeholders involved believe. So in that sense, I think a carbon bank that does play a role in trailblazing some of this thinking in terms of de-risking can really create that momentum. Again, here the real challenge is not crowding out private sector investors. So roles of banks sort of taking over, and we've seen some of these initiatives that have been trying to sort of capture all the supply and then provide demand, to the different players, including large private players like us. It's interesting, but it's very delicate. It can really undermine market forces on the supply side. So again, we need, if we need a carbon bank, it needs to be an enlightened one that works on de-risking, both on nature-based solutions, on CCS, but at the same time is open to then letting it go and letting the private sector, run with it.
So not a bank, but an enlightened bank. Go ahead.
So I like this idea of enlightened bank because one of the things, as I was reading about this topic, and I've read some things from 2011, so it's not a new thing, and a lot were complaining about the government control of it. It's like putting it under a public authority or leaving it to an independent management system. And they were saying that with political control over it, you're exposed to the same thing as we are facing today. It's like politicians are not taking a lot of steps because they are afraid of public backlash. So that was one point that I have in mind. The second point, we are talking about the mammoth here. We have the ETS with, 12,000 compliance entities. Then we have ETS2, which adds to that. And now we are talking about integrating carbon removals. The scope of this market is expanding at a rapid pace, and we are complaining that in our current situation we see it hard to evolve. It's automated, but it's still slow. Imagine how hard it will be to manage so many entities all at once and provide solutions that are efficient for all the actors involved, all the actors that stomach differently the carbon price. And I think one last point, because in your introduction, Andre, you said we need carbon removals for hard-to-abate industries, and I think in your paper you actually name it to to drive a virtuous behavior in hard-to-abate industries. But I think we need carbon removals for more than hard-to-abate industries. We need them for unavoidable emissions, because at the end of the day, and with technological evolution and innovation, hard-to-abate industries can decarbonize. Maybe not now, but in the future. So unavoidable emissions are key there.
I think, Joanna, actually, I should look at that paper again, because somehow that sneaked in. Because as ERCST, we're actually very technology neutral. I don't have any particular hang-up against CO2. My only problem is the CO2 in the air. And if it's CO2 somewhere else, I don't care. I mean, there's always been CO2, there's always been CO2. So we are not on carbon removals only for hard to abate or for this. It's for whatever it's economical. In the end, if we're true to what we're saying here, we're not declaring war on anything in particular except on CO2. And if it's economical, whatever the economical solution will be, what the economical solution will be. I'm not an economist, but once in a while I like to dabble into this. Sorry.
So, several key points. I think starting from the end, these hard-to-abate technologies are very crucial. So you have to be assured that there will be emission at the end of the 2050 and even beyond. So this is not the economy will stop. So even if you maintain the balance, so you be neutral. So that means that the emission you are still existing in the sectors with the hard abatement solutions, then you maintain it with the removals, or LULUCF, whatever you call it, is a technological or natural based. But it means that the emission will still be in place after 2050. So if the economy will rise and if you look on the numbers of people and the population of global, then it's rising up to 2100. So the momentum of decreasing the population in several assumptions is after 2100. So that means that we are talking still about 2050, so the emission will be still problem. And the second thing is that the hard-to-abate sectors are not only the sectors that we are thinking at the end, so the agriculture and etc., but also industry, because you don't know now what would be the speed of the transformation and technological progress and the new materials and etc. So we now, in a couple of years, we are now, because of the war in Ukraine, we observe the supply chain, the changes, the cost of the technology, cost of the prices of fuels, etc. So the cost of the production in Europe and globally increase. And technological progress is also not because of the price, but the availability of materials, fuels, and workforce, whatever you name it. So this is very crucial to have in mind that there will be emission in 2050. So I will maybe stop with that. But other things was with the carbon banks. It should be independent, but you got several examples of central banks. So you can call it if the central banks is independent or still politically driven, but as we can observe in several central banks, they are working. So that means that this is a solution in place that you can look at and find the best way suited for the ETS market.
If I can go for a moment to Peter. He's based in Singapore, but he's also been around in the carbon markets for a long while. So be interesting to hear what you think, because you look at it for more, you know the EU, but you're looking for more global. Sorry.
Yeah.
Hello. Hi. Thank you, Andre. So a couple of thoughts. These are not questions. These are thoughts, just so you know. The idea of a carbon bank is very workable in an EU context because the EU has a carbon budget. As we know, one of the deficiencies in the Paris Agreement is we all acknowledge there's a carbon budget, but we haven't allocated the carbon budget between the countries, right? But the EU has a carbon budget. It set itself its carbon budget, and therefore it has a carbon budget that needs to be managed, but it also doesn't manage it just for one country. It manages it for 28 countries. So if you think about that, there needs to be a common management of that, which currently is done by the Commission. But it's done on the basis of political expediency. It's not necessarily done on the basis of allocation of economic resources between the EU. What you have is member states fighting with each other over which part of the allocation they deserve more than the next person. And then you see backhander decisions like, okay, you get the benefit of the new technology fund or the decommissioning fund or something or the other, but please sign up to this. So what you could do is you could depoliticize that by having a central bank to manage the overall carbon resource within that budget for the EU. The thing that I haven't heard the panel talk about is a recognition that beyond the EU ETS, there is also the effort sharing budget, which still falls part of this 1.5 net zero target. So in order for a net zero target distribution to work appropriately, you need the coordination of both what's happening in the effort sharing perspective with what's happening within the EU ETS. And don't forget, the effort sharing budget is constantly being adjusted as we now create EU ETS 2 as an example, right? Because there are things that used to be part of the common budget, the effort sharing, that is now coming into EU ETS 2. So the transition of EU ETS to be able to accommodate all of these things towards a net zero target isn't just based on the EU allowance price. Because the EU allowance price is only looking at the price of carbon within its sectors. There's an entire world of carbon costs sitting outside in essentially the effort sharing place, which is not priced. It's not priced in. So therefore, the true conversation around net zero transition involves a bridging of these two aspects. And that's kind of where I see a carbon bank having a role to play, which currently it isn't. No one's talking about it and no one's thinking about it. It's just a political bun fight every single time there's a sort of new version of an EU ETS piece of legislation that comes through.
There's also, Daniele first and then you, but Daniele, for instance, we did go this time for the Repower EU, we've gone into the reserve and kind of auction stuff. So that kind of, isn't this an intervention? And rather than having that hawk up, you would have somebody was it independent. I mean, is the European Central Bank independent? Yes, no, maybe. So is it also an example of things that could be managed or should be managed, because the price, like the price of money, the price of carbon is very critical in ensuring that you have some level of stability and prosperity in Europe.
Yeah, I have to say, and again, I'm coming at this from the role of a large utility. We almost have 100 gigawatts of power. We were one of the leaders in sort of managing portfolios of carbon credits under the Kyoto Protocol, but we're also part of the World Bank initiatives back then, and we're also part of some of their thinking right now, as in we're engaging with them. I see what you mean, and to me, a bank that does the politics is not a bank. It loses credibility, and we're seeing what is happening with the European Central Bank. I mean, I personally support, as a company, we don't have a position, but I think when a bank starts interfering with political decisions, it gets very, very complicated. And so in my eyes, the type of issues that you were mentioning, should not be part of a carbon bank solution. Otherwise, it means already sort of it's going to take us 20 to 30 years to set it up, and it's going to be very controversial, and it's going to create a lot of uncertainty. Everybody's going to be waiting. Let's see what the central carbon bank is going to say. So to me, a carbon bank here, again, has to be a facilitator of letting the price emerge. I think there's two very different discussions, and I agree with you on a role of a carbon bank in Europe in terms of removals, in terms of letting the carbon price in hard-to-abate sectors emerge. We all know that Europe is experimenting with CCFDs, which means if you introduce a CFD, you will not need €1,000, carbon price to get there. It just helps level out. So a carbon bank that comes in with a specific mandate to do CCFDs may help mitigate some of those price spikes. And at the same time, I'll close again, also at the global level, we are struggling. I think the private sector is doing a great job in trying to push this thing forward, but it seems we're not going fast enough. And a role for a bank, again, to do CCFDs with hard-to-abate sectors in emerging economies on a sectorial base could help let the right price signal emerge and also converge, create a consensus over the MRV needed. We have a lot of lessons learned from before, a more credible. There's a lot of private sector initiatives that are doing a great job, but obviously they're not strong enough to overcome the resistance of a number of stakeholders, and maybe working also with a bank would help to get that momentum over.
I don't know who has Mike. Philippe, you have, and then Robert.
Okay. Indeed, the maturity, my perception of the maturity in Europe on climate change is not sufficient for politics to release decision powers to a financial central bank. We can all dream to have it, but let's say that I have my doubts on that to occur. Now, the other point you raised is about the ETS2, which is another dimension, which today price level is probably not going to deliver a lot of emission reductions. It's far from the cost curve in the sectors that are under the ETS2. But it's a starting point. It's a starting point. Can it help stabilize the ETS? Because the direction to reduce in ETS2 is probably slower than in the ETS. Maybe. That's something that needs to be explored. But because it's two very fundamental domains, and you're talking economic policies here, I don't see full linking happening overnight, which means, again, you need a stability mechanism in between. And that's where a bank can help also create progressive convergence, cohesion, but without terrible impacts when we talk, because at the end of the day, at least for, I'll speak my own chapel for the industry, we're talking jobs behind.
There's a gentleman there. Go ahead. Go ahead, please.
Thanks, Andre. So I think lots of good
If you
points.
just want to tell folks who you are, so
Yeah, so my name is Malik. I'm the co-chair of the International Emissions Trading Association International Working Group following Article 6. I think the idea of a global bank is interesting. And I know we focused a lot on the EU. Earlier on, there were points made on implications for 6.4. So just curious to hear from panelists where they think this idea could materialize and how it could feature in the negotiations or next year.
Well, the only answer that I would give you is that there is a reserve being put in or proposed in 6.4 to be put in place. It's a variation of, if you want, the functions of a bank that would backstop the risk. It's one way. It's not based on somebody very deep pockets. It's just sucking out of, if you issue 100 credits, you would put in, 5 in the bank. And at some point, if somebody's forest, burst up or whatever the heck happens, then you can take it out and replace it. It's another way of doing it. I think it's the way that the UN can do, because the only way that, at least if the UN wanted to do something like this, would go to the World Bank, basically, and said, you're big, you're around, and you have some level of permanence, if anybody has a level of permanence, and could you do this? I'm not sure. Well, you heard the president of the World Bank, you heard the president of the IFC. They're all very committed to carbon pricing, but I think for the moment, there is this approach that we mentioned. If you were to do this kind, think about it in a different way, though. If you were to do this kind of stuff not under 6.4, because under 6.4 you've got this. It's a centralized mechanism, so they have the ability to create this reserve. Under Article 6.2, if people do projects with removals, is there an institution or is there a mechanism to put in place an institution or a function that would do the same thing? The answer is no. And I think that there will be a lot of resistance from parties that see this as being decentralized before they would agree to a central function that they would create to backstop a certain asset class. So I would, it hasn't come up, but the reason why we bring it here, because we think that it's a discussion that's worth having. There will be people like you, people like your members. At some point, they're going to start wanting to have removals, and the question is, who's going to backstop that risk? Who provides that? Who's permanent enough and big enough? I don't know.
So exactly what Andre is saying, that in Europe we are observing the same situation as global. So this removals has to be start, and we are working in Europe in certification of this units and the whole monitoring, verification, baselines, etc. But there is no market, so you have to work on the market and create the demand for that. So just before what it's needed on the cost of the carbon price in ETS will increase enormously. But I will argue with the previous statement, because I totally disagree with the view of what is happening in ETS. I mean, if you look at the basket, as you said, ETS 1, ETS 2, non-ETS, which is merely existing before 2030, because you will increase you incorporate in ETS the waste. So that means that in non-ETS, the only thing is left is agriculture, and the discussion on ETS on agriculture already started. So if you're interested in what's happening in Europe now, you can observe 300 pages document set up by the Commission how to implement the ETS on agriculture. So that means that after 2030, you will have 3 ETSs, or carbon pricing mechanism, which means that we did this impact assessment, like 150 pages modeling on what happening if you incorporate ETS on other sectors than are already in ETS, and the marginal abatement costs in other sectors in non-ETS, you call it, or ETS2, are enormously higher. But still, you need, because of the end of the ETS1, you need expand the market more. So that means that merging two ETSs 1 and 2 would be obvious. But it means that at the end you will have high prices. So that the question, what to stabilize the price of this one big ETS. And the removals are quite interesting solutions, but they have to be maintained. So the central carbon bank is one of the solutions. And I think the questioning, let's say, some kind of thinking that this is not the best solution at the moment in ETS are, of course, they are valid. But I think in time, the more you are taking care in the climate policy in Europe, and not only in Europe, then you see that there is no better solution than carbon bank. And I think it's worth to discuss that, because sooner or later, politicians will decide that this bank will occur. So I'm sure that will happen.
Well, look, I think that we're not here. We can hope, but we didn't think that they're going to all stand up in the plenary and kind of decide to create a global carbon bank. As much as I'd like to be on the board, but that's not something that's going to happen now. But what can happen, and what these side events are, and we did invent kind of this massive side events. I think in the COP, Saida had a very good hand in creating this massive amount of side events, interesting side events, is that you bring it to the public debate. And whether it's going to catch on here or is going to catch on later or is going to never catch on, I think the role of a think tank like ours to try to bring this thing to the public forum and see where it comes. But some solution will need to emerge, and whether it's now or it's later or there's somebody else's idea, but it's something that is clearly is the function, maybe not the carbon bank, but the functions that are being described here are becoming increasingly necessary. What I'll do now, I'll start with Ioana, like your last kind of, what do you take away from this, and any other thoughts that you may have?
Well, thank you very much, Andre. What I take away from this is that we definitely need something that helps us keep the markets stable, whether a bank or another kind of institution. It's remaining to see. We need something that reacts fast, that adapts fast, and I like the idea to start discussing about this now, because it takes a lot of time in Europe, but also globally, to set up anything. So it's time to start discussing about it, whether we like it or not, and to find solutions on how we can make this system function in the future, because we have a big challenge ahead of us.
Yeah, no, I think the topic is definitely very relevant. Again, I'd like to share with you, as Enel at the moment, we have targets that are SBTi certified, net zero by 2040, but the net means that most of our reduction are going to be absolute zero, so we don't see a huge role being played out for offsets in our strategy, at least a very little role. But the price stability and the long-term price signal, we have a hydrogen business that is engaging with our clients, and again, long-term price signals are very important. So we see, the current efforts of the EIB in Europe, the World Bank at the global level, and exploring their role in de-risking as a very important one. Be it de-risking because of regulatory developments, because of sort of integrity and permanence, but it is very important, and it has to again be seen as not intrusion into the markets, but helping the markets emerge, and so very delicate without taking a political role, which should be left to governments.
I can only agree with what was said. So I think we all agree with this momentum for thinking about the future of carbon pricing and ETS in Europe. But I think what I would take from that is that the thinking and that this momentum won't last long. So that means that we have a price of 100 around 100 euro in Europe. So, which is enormous if you get back 5 years ago and think that in 5 years' time you will have 100 euros. This prices should be in 2030 or more, and up to 2030 you will have to be prepared for 150, 200 euros. That means that this is quite challenging for the society, and that means that this carbon pricing momentum for delivering the architecture for climate policy in Europe, but Europe is like the sensitivity of the carbon pricing development globally. So that means if we do it wrong, that means that will be the end of carbon pricing globally, ETS as it is. So we should focus on every aspect of the architecture of climate policy, including ETS, in up to 2040, but even longer. So the discussion up to 2040 started next year, but we should focus on 2050, so net zero. And this architecture, if you make it right, that means that their carbon pricing will stay for a longer period. And that I would like to see.
Last word from Philippe.
Not easy to conclude after what I've heard, huh? Except I repeat, maybe just, I mean, I agree to what's been stated. The first thing probably that what's been highlighted today is that Andrei, your CST, has got a bit of a work to do in the thinking of the solutions, let's say for the post-25, 2030, 2035. What we've seen so far, and incorporating the lessons from the past. We've got liquidity issues, we've got merging or cohesion between schemes, different schemes. We've got supporting the emergence of negative emissions. All this, it's probably different attributes. I'm not sure it's a single carbon bank concept that fits these different targets or objectives. Okay. I think it's probably different concepts. We heard about de-risking, and that's instrumental. The one thing I pray for is that we keep the concept of markets. And it's not because we are in a Ayeta room today, but because basically, from an industry standpoint, from a company engaged into going to net zero, markets is and stays by far the preferred instrument to manage our transition toward this famous net zero. I'll stop here.
Thank you, Philippe. And yes, everybody, yes, we are in the AIDA room. And if you listen to the IFC and the World Bank and the WTO and all the TOs, they all profess a deep love for markets. But on the other hand, also Danielle is right that in spite of the profession of love for markets, they turn around and the next thing they do, they put another regulation. That's kind of what invariably happens. So the question that needs to be asked is, there seems to be a desire or determination by society to somehow manage markets. There seems to be that determination. To some degree, do you want to do it? I don't want to betray my biases, but if you want on a quantitative rule-based system, or do you have people kind of make decisions for you because this is what people do? Or, central banks will set up the price of the money, and we all watch every day or every week when the central bank or the European Central Bank or the Fed or whatever it is gets together and decides what the interest rates would be. There's nothing unusual in that, and we got used to it. Sometimes they get it wrong. Sometimes you're looking for a soft landing. Sometimes you do this or the other thing. But it's quite clear that they play a role. Is it more than one? Is it a number of functions, as Philippe said, the risking, the early start of the removal market, the managing of the price if you want, because we're dealing with some real impacts here. Whether you need a number of them, or do you want to split them, or do you want to keep them all together in something that manages prices? And we haven't even spoken about the prices related to CBAM, to the carbon border adjustment mechanism, that also are going to have to be hedged through the ETS and ETS allowances in the context of the EU. You could have a number of adjustment at the border around the world. Can you do that? You hear people screaming about unilateral trade measure. We don't want unilateral trade measure. Is there a need to somehow manage that situation with barriers beginning to emerge around the world? We don't have the answers. We're not sure that we have something to give you right now, but it's certainly we hope it's food for thought. We hope it's food for thought. We hope you all run back to your delegation and tell them to think about it. So anyway, I want to thank these are my friends and my colleagues and some of you that I know very well in the room for being here. I hope you found it somewhat interesting and food for thought. And we'll see you at some future events that we have here and in other places around this campus. Thank you very much all for coming, and thanks to the speakers.